1. Start with energy, explain with authority, highlight with emphasis, end with warmth. As the U.S. markets are closed for the weekend, we can look at the final numbers from Friday, November 7, 2025. Supermicro Computer Inc., ticker SMCI, ended the official session at $39.76. That was a loss of 1.43% or 58 cents on the day. However, the story didn't end there. In after-hours trading, the stock clawed back all of its losses and then some, rising 71 cents or 1.79% to settle at $40.47. That single day's action, the dip and the after-hours recovery, is a perfect miniature of the entire violent, confusing, and contradictory story surrounding this company right now. The stock is down more than 28% in the last month alone, and the immediate expectation, if you just glance at the headlines, is that this is a broken growth story. The company just reported a massive miss on its quarterly earnings and gave shockingly weak guidance for the next quarter. From a distance, it looks like the AI bubble has burst for this high flyer and it's in a tailspin. But the reality, buried in that same disastrous-looking report, is a single number that changes everything: a full-year revenue forecast of at least $36 billion. This isn't a company dying. It's a company that is apparently choking on more demand than it can handle. The common belief about Supermicro is that it's a box builder. It's seen as being in the low-margin, commoditized business of assembling servers, competing with giants like Dell and HP. It's the kind of stock you might see on a momentum list on your Robinhood app, a name that got caught up in the Nvidia stock frenzy and is now coming back to earth. The narrative is that its 52-week range, which stretches from a low of $17.25 to a high of $66.44, is proof of its volatility and that the party is now over. This perception is the core of the bear case. But the challenge to that thinking is that SMCI is not a simple box builder. Its entire business model, which it calls building block solutions, is its strategic moat. This modular design philosophy allows it to integrate the absolute newest, hottest, and most powerful chips, whether from Nvidia stock, AMD, or Intel, into its systems faster than any of its larger competitors. While competitors are re-engineering their entire server lines for a new chip, SMCI can reconfigure its building blocks. This makes it an essential high-speed integration partner for the AI build-out, not just a replaceable supplier. It's the reason why, when big tech companies need the latest GPUs at scale right now, they call Supermicro. Let's dig into the recent price action because it's all tied to that bombshell earnings report from November 4th. The stock has been hammered, and for good reason. The company reported first-quarter non-GAAP EPS of 35 cents, which was a staggering miss from the 46 cents analysts expected. Revenue came in at $5 billion, nowhere near the $6.46 billion consensus. To make matters worse, they guided for second-quarter EPS of just 46 cents to 54 cents, which was, again, in the words of one analyst, significantly below consensus. This is the data that sent traders on platforms like SoFi Invest running for the exits. This is what the bears are shorting. It looks like a complete operational failure. But then you read the rest of the report. In the same breath, management guided for full-year fiscal 2026 revenue of at least $36 billion. This is an astronomical figure that implies a biblical ramp-up in the second half of the year. Management backed this up by stating they have a rapidly expanding order book, including more than $13 billion in Blackwell Ultra orders. Blackwell is Nvidia's next-generation AI chip. This single fact completely reframes the narrative. The Q1 miss and Q2 weak guide aren't a demand problem. They are a supply chain and cost problem. The company is spending everything it has and destroying its short-term margins to retool and build the capacity to deliver on a $36 billion pipeline. This is the central conflict. The market is weighing a disastrous present against an almost unbelievable future. The number one risk and the bear's entire thesis is profit margins. Gross margins collapsed to just 9.3% from 13.1% a year ago. This is, to put it bluntly, atrocious. This is where the box builder argument gains its teeth. The company blamed an unfavorable customer and product mix and high costs associated with ramping up these massive new deals. In short, they are sacrificing all profitability to grab market share and fulfill these giant orders. Net income fell from $424 million in the same quarter last year to just $168 million. This is why the stock is trading at $39 and not $69. The bull case, which is what long-term funds at Fidelity Investments or those setting up Schwab Intelligent Portfolios are betting on, is that this is a temporary strategic investment. They see the $13 billion in Blackwell orders as a locked-in contract, and they believe that once the new, efficient manufacturing lines are running at scale, the margins will return. The bears look at the 9.3% margin and see a company that has permanently lost all pricing power and is in a race to the bottom, a value trap. What does Supermicro actually do? Its building block solutions model is key. It designs modular components, motherboards, chassis, power supplies, and cooling systems that can be mixed and matched. This is why it has such a tight relationship with Nvidia and AMD. When Nvidia announces a new platform like the GB200 or the Vera Rubin, Supermicro is already a launch partner because it can integrate those new systems with minimal re-engineering. A huge part of this is their green computing focus. Their custom direct liquid cooling plates are a critical selling point for data centers trying to manage the insane power and heat from racks of new generation GPUs. This isn't just an eco-friendly marketing tactic, it's a core engineering advantage that allows for greater density and lower operating costs, which is exactly what hyperscale customers like Apple stock, who is a known customer, and other AI cloud providers are desperate for. This isn't a self-investing gamble on a meme stock, it's a bet on a highly specialized engineering company that has become a critical bottleneck in the AI supply chain. This is why, despite the terrible quarter, institutional ownership remains incredibly high, with nearly 1,500 institutions like Vanguard and BlackRock on the books. This isn't a retail-only play. This brings us to the future outlook, which is a true binary. The catalysts are obvious and massive. First, the execution of the $36 billion revenue guide. If they hit that number, the stock is impossibly cheap at $39. Second, the $13 billion in Blackwell orders turning from a backlog into shipped revenue. And third, and most importantly, any sign of margin improvement. If SMCI reports next quarter that margins have bottomed and are ticking back up to 10 or 11%, the stock will likely re-rate significantly higher, as it would validate the entire bull thesis. This is what traders on Interactive Brokers are watching for. But the risks are just as large. The number one risk is that the margins don't come back. What if this is the new normal? What if competition has forced them to permanently accept 9% margins to keep these big customers? If that's the case, the company can grow all it wants, but it won't be profitable, and the stock is probably fairly valued right here. The second risk is execution. Can a company of this size really scale its operations to handle a $36 billion year without something breaking? This is a monumental task. Finally, there's concentration risk. The company's fate is almost entirely lashed to Nvidia stock. Any supply chain hiccup at Nvidia, or any decision by a handful of its massive customers to switch suppliers, would be catastrophic. Comment below with what you think is the biggest risk for Supermicro, supply chain constraints, or a permanent collapse in their profit margins. This is the question that every investment in this name boils down to. It's the kind of complex story you need real investment help to understand, not just a headline. The online investing community is at war over this name, with technical analysts pointing to the stock being deeply oversold, while fundamental analysts are split right down the middle. In summary, the market expects Supermicro to be a story of a failed AI stock, looking at its 28% drop and horrific quarterly miss. The reality is that the company is a victim of its own success, buckling under the weight of a $36 billion order book that it is desperately trying to build capacity for. The stock has been viciously punished for sacrificing all its short-term profits to meet this demand. The entire individual brokerage thesis on SMCI has shifted. The question is no longer if the demand is there. The $13 billion in Blackwell orders proves it is. The question is whether SMCI can execute on this demand and in the end actually make any profit doing it. Disclaimer. This content is for informational purposes only. It's not financial advice, so don't make any decisions without doing your own research or consulting a professional. If you found this helpful, don't forget to like, comment, and share.
That was a loss
Stay
of
smart with your money.
1.43% or 58 cents on the day.
However, the story didn't end there.